Okay, it is February 14th, 2026. And if you're looking at the global energy markets this morning, you are definitely not seeing hearts and flowers. You're seeing, well, it's a collision. We have these three massive forces just slamming into each other right now.
Collision is absolutely the right word.
Right.
It's messy out there.
First, you've got this trade war that has basically built a wall around the U.S. energy sector.
And then you have developers canceling projects because their costs just doubled like overnight.
And then second, the artificial intelligence boom. It's sucking up power faster than anyone can seem to generate it.
Oh, yeah. Data center operators are practically begging utilities for more juice. It's been a chaotic start to the year.
And that's where we're focusing today. That's the third force the company's caught in the middle. We are looking at Fluence Energy. Ticker is FLNC. Now, usually when we talk about Fluence, the conversation kind of stops at they make big batteries. It's a hardware story. But looking at this stack of sources we have, the Q1 2026 earnings from 10 days ago, the new tariff rulings, reports on AI grid software, I get the sense that just calling them a battery company it feels outdated.
It's entirely the wrong framework. I mean, if you just look at the numbers they released on February 4th, and you combine that with the whole geopolitical landscape, Fluence is, well, it's morphing.
Morphing.
Yeah, they're becoming a critical infrastructure player. They happen to use batteries as the hardware, but the real story is it's increasingly about data and defense.
Defense against what?
Defense against a totally chaotic supply chain, for one,
Yeah.
and defense of the electrical grid itself against all the volatility that, renewables introduce.
Okay, so let's start with the scorecard then. They just dropped their Q1 2026 numbers. I'm looking at the headline revenue. $475.2 million for the quarter. On paper, that is a monster jump, up 154% from last year.
But massive growth, just
Yeah.
massive.
But I have to play devil's advocate here right away. When I looked a little closer at the bottom line, they still posted a net loss, $62.6 million. So
Yeah.
if I'm an investor looking at their stock performance, why shouldn't I be worried? Revenue is way up, sure, but they are still burning cash. Isn't the goal to actually make money?
That's a fair question, but you have to look at the seasonality of the specific industry. It's a bit quirky. In the energy storage world, the first quarter so, October through December, it's notoriously the slowest.
The winter lull.
Exactly. It's the winter lull. Projects just don't come online in the freezing cold at the same rate they do in, say, the summer. So a net loss in Q1 is actually, it's standard operating procedure. It's structural. It's not a failure of the business model.
So you're saying the loss is a feature, not a bug?
In Q1, yes, absolutely. But look at the guidance. That's the key. They reaffirmed their full-year outlook for 2026. They're projecting $3.2 to $3.6 billion in revenue.
It's something like 50% growth year over year.
It is. But the number that really matters, the number that tells you if this business actually works, is the adjusted EBITDA.
Right, which they're pegging at a positive $50 million midpoint for the entire year.
Exactly. And that is the pivot point. For a decade, this industry was all about growth at all costs. You just burned cash to grab market share. Fluence hitting positive EBITDA in 2026. That signals that the startup phase is dead. They're entering the industrial major phase. This is all about operating leverage now.
Okay, but guidance is just a promise, right? I can promise I'll run a marathon next year. Doesn't mean I will.
Yeah.
How much of this revenue is actually real? Because in the construction world, things get delayed, permits get denied. Is this $3.6 billion just fantasy money?
And that's where the backlog comes in. As of December 31st, 2025, their backlog is sitting at $5.5 billion. That's the highest in their history. But here's the little nugget from the report that really matters. 100% of their forecasted revenue for 2026 is already covered by that backlog.
Hold on, pause on that. When they say covered, does that mean signed contracts? Or is that just, handshake agreements and letters of intent?
No, these are signed orders. They have visibility on every single dollar they plan to earn this year. In a market this volatile, that is a massive safety net. It means they're not out there chasing sales to keep the lights on. They're just executing on what they've already sold.
Okay, so the books are full. They've got the orders.
Yeah.
But execution, that's where things get messy, especially right now. We have to talk about the elephant in the room. Or maybe the dragon in the room. The trade war?
Yes, the Liberation Day tariffs.
It sounds so dramatic, but the numbers back it up. We are looking at these Section 301 tariffs on Chinese imports. As of January 2026, the sources are saying the total duty on Chinese batteries and BS battery energy storage systems is now 82%.
82%. Just think about the math on that for a second. If you're a developer and you budgeted, say, $100 million for batteries from a Chinese supplier, your cost just jumped to $182 million overnight.
That kills the project. There's just no way the margins can sustain that.
It kills the project, and it very likely kills the developer if they aren't diversified. The industry is in a state of absolute tariff shock. We're seeing reports of projects getting canceled left and right because the economics just completely broke. The supply chain has turned into a minefield.
So if the industry is melting down and everyone is scrambling, why is Fluence projecting 50% growth? Surely they use some Chinese parts too. They can't possibly make everything themselves.
They do use global parts, but they saw this coming. This is really where strategy beats luck. Years ago, Fluence made a very specific bet on domestic content. They signed a multi-year deal with AESC in Tennessee to manufacture battery cells right on U.S. soil.
Ah, so this is the moat all the analysts are talking about.
It's a moat made of pure regulation. Because their cells are made in Tennessee, their product qualifies for the domestic content bonus under the Inflation Reduction Act.
Okay, so let me get this straight. Competitor A is importing from China and paying an 82% penalty. Fluence is shipping from Tennessee, and their customer gets a tax credit.
Exactly. It is a double swing. Their VP of Policy, Suzanne Letta, pointed this out in the source material. It's not just that Fluence avoids the tariff, it's that their product is effectively cheaper for the utility company to buy because of all the tax incentives attached to it.
That's like the difference between buying a car with a massive luxury tax versus buying one that comes with a government rebate. The price gap just becomes impossible for the competitor to bridge.
And it's not just the U.S. The sources also highlight that Fluence has diversified their manufacturing into Germany, India, and Hungary. They're not reliant on any single geopolitical choke point. And in 2026, supply chain isn't just logistics, it is the primary competitive advantage. If you can't get the batteries across the border without doubling the price, it doesn't matter how good your tech is. You just lose.
So they have the hardware side pretty much locked down. They've got this shield against the trade war. But I want to pivot now to that third force we mentioned at the top. Artificial intelligence.
The tech catalyst.
Right. We hear AI thrown around so much, it's almost losing its meaning. Every company claims they're an AI company now. But in the energy sector, it feels, it feels very tangible. This isn't just marketing fluff, is it?
No, this is physics.
Yeah.
And AI impacts Fluence in two very distinct ways, on the demand side and on the product side.
Okay, let's start with demand. Data centers.
So Julie Nebreda, the CEO, was very clear about this. Their pipeline of potential projects has jumped to $30 billion. That's up 30% in just a few months. And a huge driver of that growth is data centers.
Walk me through the logic here.
Yeah.
Data centers run 24/7. Solar and wind are intermittent. Wouldn't they just want natural gas or, I don't know, nuclear? Why are they buying batteries?
They would love nuclear, but you can't build a nuclear plant in 18 months. You can build a data center in 18 months. So they are desperate for power now. And because the grid is so congested, they are pretty much forced to co-locate with renewables. If you're building a massive AI training cluster out in the desert next to a solar farm, you absolutely need batteries to bridge that gap when the sun goes down.
So the batteries are basically the insurance policy for the AI models.
Precisely. You cannot have a brownout when you're training a trillion parameter model. The cost of failure is just too high. The battery ensures that what they call the 5 nines of reliability are met, even if the wind stops blowing.
Okay, so that's AI driving sales of batteries. That's the hardware side. But I'm actually more interested in the software side, the Fluence IQ and Mosaic platforms. The report says they are targeting $180 million in annual recurring revenue, or ARR, by the end of this year.
This is the part that Wall Street really loves.
Why, though? I mean, $180 million seems kind of small compared to $3 billion in hardware sales. Why does everyone get so excited about the smaller number?
Because it's small in revenue, but it is massive in value. Hardware is a low-margin game. Selling a steel box full of lithium might get you, what, a 10% or 15% margin? It's a commodity. But software margins can be 70%, 80%, and it's recurring.
It shows up every year without you having to resell the box.
Right. And Mosaic isn't just some dashboard that shows you how much charge is left in your battery. It is an algorithmic trading engine.
Break that down for me. How does a piece of software make a battery more profitable?
Okay, think about the California grid. In the middle of the day, there is so much solar power flooding the lines that prices can sometimes go negative.
Negative, as in they pay you to take it.
Yes. The grid will literally pay you to take power because they have to balance the frequency. But
Yeah.
then at 7 p.m., when everyone gets home, turns on the AC, and the sun goes down, the same as duck curve prices spike, they can go to $100 or $200 per megawatt hour instantly.
Buy low, sell high.
Exactly. But it happens in milliseconds. Mosaic automates that arbitrage. It predicts those spikes using weather data, grid congestion models, historical trends. It tells the battery, charge now while they are paying us, and discharge now while the price is sky high.
And a human can't do that.
Not at the speed and complexity of the modern grid. I mean, we're talking about thousands of bidding nodes and 5-minute interval markets. A human trader can't react fast enough. The report we saw mentions that in California and Australia, assets using this AI bidding software saw a 40% to 50% revenue uplift compared to manual trading.
50%.
50%.
That's staggering. If I told a real estate investor I had an app that would increase their rental income by 50% just by changing when they collected rent, they wouldn't believe me.
It sounds like magic, but really it's just efficiency. The grid is incredibly inefficient. The AI just exploits those inefficiencies to generate cash. And this is why that AES deal you see in the sources is so important. They're onboarding 1.1 gigawatts of power onto this platform.
So Fluence is evolving from a company that sells you a box to a company that manages the box for you forever.
And takes a cut of the profits. That is the SaaS model, software as a service. It makes the business sticky. Once a utility integrates Mosaic into their workflow and sees that 50% uplift, they're not going to rip it out. They become a customer for life.
It really feels like 2026 is a prove-it year for them. They have the protectionism working in their favor, they have the AI demand, and they have the software product.
You know, one of the sources from the Anadolu agency in Turkey used a great phrase for this year. They called it a dönüm noktası.
My Turkish is a little rusty. What does that mean in this context?
It means turning point. The perspective there is that storage is moving from allocated capacity, which is just, spreadsheets and press releases and promises, to actual field deployment. We're seeing the steel in the ground.
So the hype phase is over.
The hype is over. The build phase has begun.
Yeah.
And that applies to Fluence specifically. They have to deliver that $3.6 billion in revenue. They have to prove the software works at scale.
And that construction phase is where the rubber meets the road. Or, I guess, where the tire meets the grid.
Huh, nice segue. You're thinking about V2G.
Vehicle to grid. Yeah, the report touched on it briefly, but it feels like a total wild card.
It is the ultimate wild card. If you have millions of EVs plugged in, you essentially have a distributed gigafactory just sitting in people's garages. Fluence's software is built to be technology agnostic. They are preparing for a world where they aren't just managing big utility batteries, but orchestrating thousands of cars.
That sounds like an absolute nightmare for grid operators.
It is a nightmare for operators, but it's a goldmine for software companies. The more complex the grid gets with solar, wind, batteries, EVs, data centers, all fighting for space, the more valuable the AI that controls it becomes. If the grid is simple, you don't need AI. If the grid is chaotic, AI is the only thing that keeps the lights on.
But surely Fluence isn't the only one doing this. I mean, Tesla's out there. Wärtsilä's is out there. The S&P Global report lists Fluence as the top global provider, but that target on their back must be getting bigger and bigger.
It is. The market is getting crowded, no doubt about it. But this brings us right back to the start of our conversation. The tariffs.
The wall.
The wall. A lot of the competition, especially the cheaper competition from Asia, is on the other side of that 82% tariff wall. They simply cannot compete on price in the U.S. market anymore. Fluence is sitting inside the fortress.
So the trade war is actually buying them time to cement their lead.
Exactly. It filters out all that price undercutting that you usually see in a commodity market. It gives Fluence a protected runway to build out that software ecosystem and capture the market share before the wall, potentially comes down years from now.
It's a fascinating setup. You have a company that looks kind of boring on the outside, industrial machinery, big white boxes. But under the hood, it's this mix of geopolitical strategy and high-frequency trading algorithms.
And that really is the lesson for the listener. In 2026, you can't just look at the technology. You have to look at the geography. Where is it made? Who is taxing it? And who controls the code that runs it?
Which brings us to the final thought. We spend all this time obsessing over the hardware, the lithium mines, the gigafactories. But if that Mosaic software really drives a 50% revenue uplift, are we approaching a future where the code controlling the grid is actually worth more than the energy moving through it?
That is the trillion-dollar question. If the software captures all the margin, the battery just becomes a dumb commodity. The value migrates to the intelligence. The company that owns the brain of the grid owns the market.
Something to think about the next time you flip a light switch. The electrons might be the same, but the brain deciding when to send them to you is getting a lot smarter.
And a lot more profitable.
Thanks for joining us on this deep dive into Fluence. If you want to see what that trading interface looks like, go and search for Mosaic bidding software. It's wild to see the grid thinking in real time.
It really is the future happening right now.
We'll catch you on the next one.